Hey, everybody. Welcome back. Welcome back. Selecting the right business entity is like setting the foundation of your house. It needs to be strong, reliable, and suitable for your growth. Today, we're going to explore how to align your business structure with long term goals for optimal success and minimal stress. So, today, we're going to talk about what's the topic? How to choose the right entity for tax purposes. But before we get into what this topic is, I have to do that introduction. So my name is Shane Harris, and around here on these social media streets, I am also referred to as Shane the Negotiator. And I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That is what I do, and that is who I help. So let's get on into today's topic. So the impact of business entities on taxation. So we're going to get into the different types of entities and what that have to do when it comes to taxes. So your choice of business entity affects how you pay your taxes, your level of personal liability, and your ability to raise capital. So begins from a sole proprietor to an S corporation and so forth. Each has its taxes, pros, and cons. So understanding these can save you a significant amount of money and protect your personal assets. So let's break down the most common types. So sole proprietors are the simplest, but often has no personal liability protection. LLCs is a little bit better. It provides a flexibility and protection. With S-Corps can save on while your S-Corps can save on self-employment taxes. So the C-Corps are for those looking to go public or to attract venture capital, but it comes with that double taxation. So let's go into some real life scenarios. So I have two of them here. Let's say we have a Lisa, which is a freelance graphic designer, and a sole proprietor. So she found her personal assets are at risk from business debts. So she switched to an LLC, which provided her protection and, of course, peace of mind. Woof! Thank you for doing that, Lisa. Then we have David, who's a tech startup. He outgrew his LLC status and he benefited from that C corporation, making it a lot easier to attract those investors. So if you go back and catch those previous videos that was done in those previous live, where I talked about the C corporations and why it will be more attractive to have it for those, why it would be more attractive to those investors. Go back and check out those previous videos that goes in a little bit more about that. So let's go through some strategic planning for growth. But we always got to try to grow, right? So think about where you want your business to be in the next 5 to 10 years. So as I mentioned in the previous live, when I have my clientele come in and they sit with me, we do that initial consultation. One of the things that I ask them is, where do you see yourself in your business over the next 5 to 10 years? This way is going to help me to decide or sit with them and figure out how I'm going to be able to best help them if they have these goals. Now, if they don't have a goal, it doesn't mean that they can't make one or we can't come up with one together on that call. But knowing what your business growth or what the goals are for your business for the next 5 to 10 years is good strategic planning for growth. So if growth and investors are in the plans and in the cards for you, then of course the C corporation might be best suited. So if you're aiming to keep things a little bit smaller and more manageable, then of course that LLC or that S Corp might be better suited for you. So let's go into some liability stuff. So liability is a big deal. So as a business owner, you don't want your personal lawsuits to affect your business or vice versa. Entities like the LLCs and the corporations separate your personal assets from your business, providing a shield against your personal liability. So this is your personal liability, and then the shields around this. Nobody trying to come, they can't get up in there. Nope. Access denied. You can't get up in here. So let's talk about making that switch. When is it time to take that switch? So if you're already in business and you're considering maybe it's time to switch to something else, I don't know. Let's talk about my options here. We'll discuss when it's time when it makes sense to change your business structure and how to go about doing it. So it's not as daunting as it may seem. And it's the long-term benefits that can be substantial. So my general rule of thumb, and it's not just mine, like I didn't make this up, is, but the general rule of thumb is if you are a sole proprietor, as I said, you are just you and your EIN, you really don't have any protection there. It's just you running a business, making some money, paying taxes, living your best life, maybe, and there's no protection there. So of course you want to switch to an LLC as soon as possible, especially if your plans is to continue to grow. So as I said in previous videos and lives, if you are making like 300K, 500K as a sole proprietor, you want to see me ASAP because you are paying way too much in taxes and it's time to make that change ASAP. So let's move on up. So now we have that LLC. So you've upgraded to that LLC, you have the protection and you still rocking and rolling and you making all this money. So at 500K, even as an LLC, yes, you have that protection because you got that bubble around you. Your personal assets and you are safeguarded from the people trying to come in there and sue you and take what you have and all of that. That ain't got nothing to do with my business. That's separate. They can't get to it. However, if you're making 500K as an LLC, you're likely also paying too much in taxes. Now, if you're making 500K and your expenses are also 500K, then you're not paying too much in taxes. You're not paying any taxes at all. But that also means that your business is not profitable. And I don't know about you, but I did not go into business to not be profitable. Okay. So the goal is to be profitable unless you're doing some type of tax planning and there's a reason why you want to spend all your money in a given year and not carry any income forward. And that's a different video for a different time. And if you want, you might want to see me if that is your goal for your business and not just randomly start spending your money in your business willy-nilly. Okay. So now, when is it time to upgrade to that S-Corp or that C-Corp, making that election? So as I said, if you're trying to, get that those investors, that's when the C-Corp will be more beneficial. For generally, if you're on the 500K or more, the S-Corp is going to usually be more beneficial to you, even though it doesn't mean that you cannot use a C-Corp. But we're going to talk about mainly the S-Corps here. So my general rule of thumb is if after all of your business expenses, so whatever you made for the year, and this is people I'm talking about if you're making 6 figures or more. I'm not talking about if you're making 50K. If you're making 50K, I'm not speaking to you. I'm talking about the people who are making 6 figures a year or more. This is going to be more beneficial to you. Now, it does not mean if you're making less than 6 figures that you cannot be an S-Corp, but I can't sit on here and explain all the ins and outs on why it would be good for you, why it wouldn't be good for you. So I'm only talking to those who are making at least 100K or more in this particular scenario. And again, I want to say this is just we're conversation is entertainment purposes only. I'm not giving advice to you particularly. I'm just giving out information for the masses. You have to do your own research, and unless you pay me that invoice and become a client of mine, this that I'm saying to you is not going to 100% apply to you. It could apply to you. You still want to do your due diligence by either coming and schedule a consultation with me to potentially become a client, or you can go to your tax pro or your professional to fact check this information and see how it applies to you and your business. Okay. Now that we got that legal stuff on out the way, boring, right? Boring for you, but not for me. I don't want y'all trying to sue my business. No. We in the bubble, right? Okay. So moving on. If you are making at least 100K or more, and after all of your expenses, like you're paying for employee wages, you're paying all these taxes, you have all these expenses that you're paying for. After all your expenses, you are netting at least 30 to 50K or more, then it's a good indicator that you are ready to upgrade to that S corporation. It's beneficial to you to upgrade to that S corporation because you have enough capital remaining to put yourself on payroll, to pay yourself wages, and also pay those payroll taxes. So when you watch all these tickety talks and all that stuff, and they tell you to go get you a LLC and then go get that S-Corp and you can pay yourself and all of that. What they do not always tell you, or the part that you tend to miss, is that you have to pay, you still got to pay taxes. The taxes are a little bit different. You pay yourself those wages. And you remember when you worked someplace and you got a W-2 and you saw those taxes that was taken out? Well, it's the same concept. The taxes still come out from you as the employee, and also you as the employer pay the other half of those taxes. That's called payroll taxes. So if that's why I said, if you are making less than 100K, this might not be as beneficial to you because you're not going to have enough profits remaining. Your net is going to be too low to have to now pay payroll taxes. Even though the payroll taxes may be less taxes than the self-employment taxes that you're going to pay, it's just too much compliance. And you may not be ready for that. So that's why I say at least 6 figures or more, then you might be in a better position to make this election. So yes, you can make that S-Corp election if you're netting at least 30 to 50K or more consistently every single year. And that's a good starting point to go on up to that S-Corporation. So I made a little chart for you guys. I'm about to pull it on up. I made a little chart to show the comparison between a sole proprietor and an LLC and what it would look like if you were an S corporation. Now, I did not do the C corporation because I'm just focusing on the LLCs and that S corp election in this particular video. I'll do a separate on S corporation by itself at a later time. Okay. All right. So let's pull on up this chart. And I need to open up my screen so I can see it a little bit better because this tiny screen is not working for me. Okay, so here is the chart. Hope you guys like it. My little Canva, made it in Canva. So as you can see, we have on the top, it says business A, and then it has business B. So business A is a sole proprietor and a S-Corp and a Schedule C, which is an LLC. And the reason why they're under the same thing, because whether you're a sole proprietor or a Schedule C or LLC, you file your taxes on your income from your business is placed on a profit and loss, which is that Schedule C, and is filed on your personal tax returns. Business B, that is the S corporation when you take that election, and that business files its income and its expenses and those loss or profits on a business tax return, which is Form 1120S. That is the business tax return. Then that business takes the Schedule K1, which is going to be an additional form that has the percentages for each partner or shareholder of the business. So if it's you by yourself, it'll just be one Schedule K1. If it's 5 shareholders and you all are 20% each, then each one of you will get that Schedule K1. You will take that Schedule K1 and you will file that with your personal taxes on that 1040. So go back to business A, which is a sole proprietor and a LLC that files their taxes on the personal taxes, that 1040, but the income and the expenses, the profits or the loss shows up on that Schedule C. And I forget what I was going to say. It shows up on that Schedule C that is attached to that 1040. It's the personal taxes versus on the S-Corp, you have a business tax, and then you take that and file it again on your personal tax. So see why it makes sense that I say, if you're making 6 figures or more, this S-Corp will be more beneficial to you because you're like, I got to do 2 taxes? Yeah, so imagine paying for a business tax and paying for a personal tax, and you're underneath 6 figures. Imagine doing that. The prices can kind of start getting up there, and you may not, even though it's still beneficial to you, you may not have enough profits to really see how beneficial it is to you, and you are likely going to get discouraged and be upset that your business is not making any money. So that's why I say at least 6 figures or more. So I hope that makes somewhat of a good sense. So let's go on over to the far left. It has entity title. The entity title is the sole proprietor and the LLC, which is filed on that the LLC, which is filed on that Schedule C, and then the S-Corp, that is the business tax. The next line we'll go into, the second line, exactly if I can point to it, revenue. Then we have from revenue, we are going to go to, it's 500K under A, 500K under B. That is the total income that we received on our made up businesses. So this is two different businesses. They both made 500K for 2023. Okay. We're going to pretend this is January 1st and we're talking about the entire year. And this is 2023's income. So let's go to the expenses on the next line. And you see in red, so green is money. That's the positive number. Red is boo. That means you're spending money on red. So every time you see red, money is going out. Green means money's good, money's coming in or money's staying. So expenses says 300K on both of them. So they had 500 that they made. After all their expenses, they had 300 remaining. So that leaves a $200,000 profits. Now I go down to owner's draw. Now owner's draw, it has under business A, 60,000. Under business B, it says not applicable. So owner's draw, this is how you would pay yourself. So many of you are LLCs who file that Schedule C on your personal taxes or you're sole proprietors, and you're often asking, well, I want to pay myself. How do I pay myself? Well, this is how you do it. You take an owner's draw. So what it is that you're doing is transferring the money from your business bank account. Hopefully you have a business bank account and you're not mixing business and personal. And if you did not catch that previous video where I talked about the distinction between the two, go back and catch those on previous recordings. So you take the money from your business bank account, how much ever you want to pay yourself, and transfer the money to your personal bank account. You can also write a check. I do not recommend cash because cash, you can't track that. If you debited money out of your bank account and you say you're going to pay yourself, you can record that in the books, but there's no way to prove that you actually paid yourself. You don't want to get into any troubles with audits with the IRS, okay? So that 60K that you wanted to pay yourself, you either transferred it or you wrote yourself a check. That's why it says 60K there. It's not applicable to the S corporation because if you go down to the next line where it says owner's salary W-2, underneath business A, it says NA, not applicable. You cannot take wages on payroll as a sole proprietor or an LLC that does not have an S-Corp or C-Corp election. So you've paid yourself by transferring the monies underneath owner's draw. Now the B business, which is the S corporation, they ran payroll because they are entitled. They have to pay themselves and be on payroll. So they paid themselves through W-2, $60,000. So they paid themselves the same way you did. It just looks differently. So let's go down to where it says payroll taxes. Payroll taxes, again, because you cannot pay yourself wages on payroll, you're not going to have any payroll taxes. So you go on over to business B, that S corporation, payroll taxes is $20,000 off that 60K. Now, this is not exact math. I just threw a number in there because depending on the state you live in and location and all of that, federal is going to generally be the same, but state's going to be different. So I just lumped it all up and I just made up a number. So don't go in there and send this to your tax professionals and be like, is she right on this? And they be like, oh, that math is not mathing. I just made up a number there, okay? So let's go on down to where it says business profits equals revenue minus expenses minus salary. So underneath business A, it says 200,000. So you see that's in green because that is how much money business A is currently profiting after they had 500 in revenue, 300 in expenses. That's 60,000 that they transferred to themselves for wages or that they wrote a check to themselves for wages does not count. So that 200,000 is what's considered profits. And to get your business profits, it's your revenue, how much you made minus your expenses, equal minus the salary, which for this particular one, there's no salary. If you go over to business B, the S-Corp took wages and the payroll taxes. So that revenue, the profits is 120K. So again, the business profits, which is 500K, equals the revenue, that 500K, minus the expenses, those 300Ks, minus the salary. The only salary is underneath business B, which is 60K, and then the payroll taxes. So 60 plus 20 is 80K, minus the 200K that was remaining leaves 120K. Business A is going to pay taxes on that entire 200K. Business B is only going to pay taxes on 120K. I hope that makes sense so far. So let's go on down to the next line where it says pass through tax amount to individual tax returns. So remember when I was talking about that K1 and it's going to pass on through? Well, this is what I'm talking about here. Now for business A, there's no K1 or anything. The profits that you have in this business is going to all show up on that Schedule C. That Schedule C is called profit and loss. So if you are doing bookkeeping, the profit and loss that you are keeping in your bookkeeping, it will literally, you'll be taking those numbers and putting it on your Schedule C because it's going to match up almost identically. So that's where the 200K is going to show profits from your expenses, after your expenses. Over here on business B, they're going to do their taxes on that 1120S. So on that Schedule K, Schedule K1 is going to populate 120,000 if it's one person as that shareholder. Remember I said, if it's like 5 of you, then you're going to have 20% each. If that's how you set it up, it doesn't matter. You each are going to have a percentage from that 120K. Yes, 120K. So let's just see. Let me do the math on that. So if it was 120K and divide that by 5 is 24,000. Each one of you will get on your K1. And then you would take that 24,000 and add it to your personal, your other business, not your business, your other income that you have on your personal taxes and file your taxes. But for this example, we're only talking about one shareholder or one member as an LLC. So don't worry about all those other things. So that 120K on that K1 is going to pass on through to you, the individual. So your business name is called S-Corp, whatever, making it up. And you, the individual, Shane Harris, whatever, is going to pass on to you. And you're going to file your personal taxes. So now we are in the personal side of things on the personal taxes. So 2023's federal tax rates for a single filer. Now, I don't want to have to list out single, head of household, married filing separate. It's the same as single and married filing jointly. It's going to have different amounts. And I didn't want to have to make this chart uber long. So we just went ahead and just put it as this one as a single filer. The tax rate on 200,000 is 32% as a single filer on the federal side. Now, this is not self-employment tax. This is just income tax. Like I said, I was trying to make it short to just kind of show quick examples. So I didn't break it up with what's self-employment income versus what's income tax. I just lumped it in all and just made it income tax. So 32% on 200K, and on 120K, the bracket is 24%. So it starts from 10% and it keeps going up in increments. So the range for 200K is 32%. The range for 120K is 24%. So I hope you got that so far. So the total taxes paid. So 32% of 200,000, that's the profits, the income that you're going to use filing your taxes, the income that you made for the year. 32% of that is 64,000 in taxes that you would have paid. The S corporation, business B, 120,000 is the profits. 24% of that is the taxes of 28,000. So business B would have paid 28,000. Business A would have or should have paid 64,000. the estimated taxes for each quarter is the total taxes that you're expected to owe divided by 4. And this is how much you have to pay every single quarter. If you miss a quarter, you will be penalized and you'll get charged extra. So each quarter, business A should have paid $16,000. Multiply that by 4, you get that $64K. Business B should have paid $28,000 in taxes. You divide that by 4, it's $7,000 for each quarter. So you see there's a huge difference between business A and business B. So when it comes time to change your business structure, this would make sense to be over here on business B, because business A is paying way too much in taxes on $500K. And that's why I said to you, if you are a sole proprietor or Schedule C, LLC without any elections, and you are making $500K, see me ASAP, because you're paying way too much in taxes. Versus if you're on the S-Corp side, your taxes is $7,000 every quarter, which is a lot better. Now, there's more things that can get done to lower the taxes on either side, but no matter what's done, B is always going to be better than A because the taxes are always going to be less. So I hope that makes sense. I hope you understand that in a good enough way. I hope I explained that where you really can get that. So let's go on back to our, minimize this screen again. And let's take this presentation down because I don't need to see that anymore. I got to get out this screen. Give me 1 second. Sorry. Can't get out my screen. Okay, here it is. We got it out now. So that's pretty much that. So the key takeaways is choosing the right entity can save you plenty on taxes. It's for protection of your assets, and it can pave the way for future expansion. So don't underestimate the power of the right foundation for your business journey. So let's go ahead and just start to wrap this on up. So to wrap it up, our discussion on choosing the right business structure, your entity is a strategic choice, not just a legal requirement. Make it wisely. So when it comes to your business, you want to take your business seriously. So I remember I made a video, a recording, a live. I did something a few months ago when I said, treat your business like you would a partner, a husband, a wife, a spouse, whatever. If you treat your business just like it was a partner or a spouse, many of you would probably be better business owners. It might work the other way. If not, because sometimes you don't treat your spouses right. But if you use that same concept and you focus on taking care and nurturing and loving your business the same fashion that you would in your partners, then your business would be in a better position. Okay, I hope that makes sense. So let me give you the little teaser for what's coming up next. We're going to talk about the myths and realities of tax planning. That's for some of the teasers that we're going to talk about. And we're going to talk about retirements. We're going to talk about retirements coming up next. So if you're really, it can really save you. We're going to talk about some hidden gems that you possibly are overlooking. So join me for the next session that we're going to have, which is going to be on Monday. And we're going to talk, actually, no. I'm sorry. I'm mixing up the dates. We are not talking about that. On the next session, we're going to be talking about IRS audit navigation. That's what we're going to be talking about. My apologies for that. IRS audits, you guys do not want to miss that, because I'm going to be dropping the little jewels on how you can, I wouldn't say audit proof, but how you can potentially save yourself from getting potentially audited. It doesn't mean that you can't get audited, but I'm going to talk about ways on how you can prevent yourself from getting audited, the lower the chances of getting audited. And even if you do, you're going to have the right things in place. So it's not going to be no big deal anyways. So it concludes my time. I hope I see you guys on the next one. And if you're on Facebook and you are seeing this on YouTube, you're like, well, why is it not on Facebook? On the Friday lives, it is not going on Facebook. You have to come on over here to YouTube to catch us on Fridays. Only on Mondays are we on Facebook. So that is it. I hope you guys enjoy the rest of your Friday and have a great weekend. And until I come back with that next topic, you guys have a good day.